I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. In this week's video blog, we take a run through the first half results of the major banks. There are 5 main components of a bank's results: growth in the loan book, the change in net interest margin or NIM, operating cost growth, bad debt provisioning and changes in asset quality, and last, changes in capital and liquidity ratios. Loan book growth was generally weaker than the market had expected. Mortgage book growth is starting to slow on a sequential basis, but during the period the main source of weakness was in corporate lending. As we transition from the long-run structural decline in interest rates to stable and eventually rising rates, the turn in the direction of debt affordability is likely to start to drive an unwinding of the rise in level of gearing that we've seen throughout the economy over the last 30 years. As a result, loan book growth is likely to fall relative to historical levels and nominal GDP. The caps being imposed on certain types of mortgage lending are also likely to result in added short to medium term weakness in loan book growth. The biggest source of disappointment for the market came from net interest margins. The mortgage rate increases pushed through by the major banks over the last 6 months were expected to deliver higher margins in the first half. However, continued pressure on funding costs and lower returns on liquidity capital resulted in sequentially flat or lower net interest margins. While the banks pointed to a better outlook for margins in the second half, the federal government announced liability levy has increased the risk to the bull case, which was built around bank pricing power. We view the expectation that rising net interest margins will driving an acceleration in bank earnings growth is an optimistic case given the rising populist political threats, ongoing pressure on funding and equity capital mix requirements, as well as a reduction in the committed liquidity facilities provided by the Reserve Bank. The main sources of upside came from non-interest income and bad debt provisioning. Non-interest income surprised as a result of stronger trading revenues in the period. This is a volatile source of revenue, and as such, it's a low quality source of upside surprise. Higher quality fees, commissions, wealth and insurance revenues were generally lower than expected. Operating costs were generally in line with expectations, with little or no growth. ANZ produced the best cost outcome, with operating costs falling around 1% on an underlying basis. Westpac and NAB's underlying costs increased around 1% relative to the first half of 2006. Lower than expected bad debt charges reflected improved asset quality primarily on the institutional side of the business. Non-performing loans remain low but appear to have reached a cyclical bottom. The net bad debt charge benefited from higher than expected write-backs and recoveries. The other positive the market took from the results was stronger than expected equity capital ratios, but even this was driven by lower quality source, with stronger than expected ratio improvement primarily driven by lower than expected risk-weighted assets, rather than the stronger than expected capital generation. The lower risk-weighted assets was a function of slower than expected loan book growth, as well as improved asset quality and mix. Overall, the risks for the banks in terms of the outlook for earnings growth were evident in the first half results. This has seen the stocks perform poorly over the last month. However, we still view the group as being expensive relative to the risks they face on multiple fronts. That's it for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.